All right, let's dive into one of the biggest, longest-running debates in all of finance, active versus passive investing. What if I told you there's a surprisingly clear winner, and that honestly, understanding this one concept could totally change the way you think about building wealth for good? I know, it sounds completely backward, doesn't it? I mean, from the time we're kids, we're taught to compete, to win, to be the best. But here's the crazy part. What if, when it comes to the stock market, that very instinct is the thing that's actually holding you back? You know the image, right? We've all seen it in the movies. These brilliant traders, glued to 6 different screens, making split-second decisions to outsmart the market. It looks so intense, so glamorous. But the real question is, does it actually work? Okay, so to really get to the bottom of this, we need to understand the 2 main schools of thought here. These are the 2 fundamental philosophies, the choice that every single investor at some point has to make. So first up, you've got active investing. Now, this is the one everybody thinks of. It's the hands-on, high-energy approach. You or some brilliant fund manager you're paying are constantly researching, analyzing, buying, selling, all in the pursuit of one single ambitious goal, to beat the market. And then you have passive investing. And the philosophy here could not be more different. It's almost Zen. The goal isn't to beat the market. The goal is to become the market. You just buy a tiny piece of everything and hold on. That's it. Simple. And this table just lays it all out perfectly. Think of it like this. Active investing is like being on a treadmill, constantly running, trying to get ahead. It's high effort, it's high cost. Passive investing, that's more like chilling in a hammock. It's low effort, low cost, and you're just enjoying the ride. So the billion-dollar question is, which one actually works better? Okay, enough with the theory. Forget opinions. Let's look at the cold, hard data. Let's check the scorecard. I mean, on the surface, active investing just sounds better, right? Who doesn't want to beat the market? It feels powerful, smart, but when you actually dig into decades of data, a totally different and kind of shocking story starts to emerge. And we're not just pulling numbers out of thin air. We're looking at the SPIVA scorecard from S&P Global. For more than 20 years, these guys have been the official referees in this whole debate. They track thousands and thousands of professional fund managers and see how they stack up against their benchmarks. So, what does the data say? Well, let's just take 1 year, 2024. A whopping 65%. 65% of professional, super smart, highly paid fund managers failed to do the one job they have, beat the S&P 500. Yeah, you heard that right. Nearly 2/3 of the pros couldn't beat a simple index. But hey, that's just 1 year, right? Anyone can have a bad year. Investing is a long game, a marathon. So let's zoom out and see what happens over the long run. And this is where it gets absolutely nuts. Because when we stretch the timeline out to 15 years, that number of fund managers who fail to beat the market, it climbs. It climbs way, way up to this. Let that sink in for a second. More than 92%. That means over 9 out of every 10 professional money managers fail over the long haul. The data couldn't be clearer. The longer you play the game, the harder it is for the active players to win. So what is going on here? I mean, these people are brilliant, right? They've got PhDs and work 80-hour weeks. It's not about intelligence. The answer lies in a few simple but incredibly powerful forces. Really, it all boils down to simple math. First, it's got minimizing costs. Passive funds are dirt cheap, so those fees aren't constantly eating away at your returns. Second, they're way more tax efficient. See, when you're not buying and selling all the time, you're not creating a bunch of taxable events. And third, and this is the beautiful part, you just own the whole market. You buy the entire haystack, which guarantees you get all the golden needles inside it. And let's talk about those costs for a second, because they are the silent killer of returns. A 1% fee? It sounds like nothing, right? It's just 1%. But over decades, that tiny little fee can devour, literally eat up 20 to 30% of your entire nest egg. That's a massive headwind that most active funds just can't outrun. All right, so the evidence is pretty overwhelming. Passive seems to be the way to go. So how do you actually do it? What are the tools of the trade? Well, the main tools in your toolkit are going to be low-cost mutual funds and exchange-traded funds, or ETFs. Just think of them as shopping baskets. Each basket is designed to hold all the stocks from a specific index, like the S&P 500. So in one purchase, boom, you're instantly diversified. The only real difference for you is that ETFs trade all day long like a stock, and mutual funds price just once at the end of the day. For a long-term investor, they both do the exact same job. And check out some of these real-world examples. Just look at those expense ratios. For those Fidelity funds, we're talking 0.015%. That means for every $1,000 you invest, you're paying 15 cents. A year. It is ridiculously cheap. And that is the absolute polar opposite of the heavy fees that act like an anchor on active funds. Okay, let's wrap this all up. What's the big picture here? What's the real lesson from this whole active versus passive showdown?
Well, all the evidence seems to point to this. True success in investing isn't about being a genius or outsmarting everyone else. It's actually about behavior. It's about discipline, patience, and just staying the course. It's about having a simple plan and sticking to it, especially when things get scary.
And hey, don't just take my word for it. This comes from arguably the greatest active investor of all time, Warren Buffett. For the vast majority of people, he says, a low-cost index fund is the single most sensible investment you can make. Even the master of active investing admits that passive is the way to go for most of us. So there you have it. The numbers are pretty hard to argue with. It seems the real path to building wealth isn't about chasing hot stock tips or trying to be a genius. It's about embracing simplicity and discipline. The evidence is clear. So the only real question left is, what are you going to do about it?